Hey everybody, it's Rick Valenzi with the Financial Zen Group. It's the third Tuesday of the month, and you know what that means. It's time for your Financial Zen tutorial. I am really excited about this month's tutorial because the subject matter that it entails is something that I've been working very hard on for you over the last 12 months. It is your first Financial Zen quarterly performance report. I've been doing this a long time. I've seen a lot of financial statements from a lot of different financial institutions, and by and large, they're all pretty useless. They throw in so much information in there, they take no time to explain it, they speak in financiers. For most people, it's completely meaningless. Even if you know what it all means, like I do, it's still confusing. And so when I started the Financial Zen Group, one of my goals was to make managing your finances as simple as possible, to give all of my clients the ability to feel on top of things and feel organized and to have a good, thorough understanding of what's going on, to empower you with the ability to stay on top of things and thereby sleeping better at night. And a performance report is one of those tools that we can use to get that peace of mind, to feel like you're on top of things, to feel like you know what you understand what's going on. And typical performance reports don't do much for you. Hopefully the Financial Zen performance reports will. So let me show you what we're talking about here. Now, before we get into it, let me add that if you're a client and you're viewing this, you already have your performance reports loaded in your client portal vault, in your Financial Zen vault. If you're not a client, this still might be interesting because this would give you a little bit of insight into what you get if you ever become one. All right, so let me show you what I'm talking about here. So the way you get to your performance report, here's your Financial Zen website, which I'm sure you're very familiar with at this point. Just click your client login to get into your client portal, as I'm sure you know. Once you get there, you'll get to a page that looks like this, where you do your sign in. And then you get to your home page, your dashboard. Now, this dashboard is for Frank and Joanna Miller. They are obviously sample clients. I would not obviously show you an actual client statement from a real living human being. And this is Frank and Joanna's Financial Zen dashboard. Now, as you probably know, all you need to do is click on the vault to get to the cloud storage that we share together. And you'll notice a new folder in there called Performance Reports. And I bet you can guess what's in there. That's right, your performance report. So here's the one for Frank and Joanna. If you click that, it'll open up into a PDF that looks something like this. Now, before I show you the details of what's inside the performance report, I want to give you an idea of the structure of it. I deliberately built this like a newspaper article. Okay, I have really kind of two different types of clients. I have headline clients who just want the headlines, they just want the highlights. They hired me so they don't have to deal with the details of minutia, and they just want to get the bottom line from me. And then I have clients that read the full article, right? Clients who want to understand the entire issue, want to understand all the details of the minutia. And yes, they hired me to manage that for them on a day-to-day basis, but they still want to understand details of what's going on. And so the way that I've built this is there's something for everybody, right? Whether you're a headline person or a detailed person, we're all going to be looking at the same performance report. And the way that I structured it is it starts with the highest level of information and works its way down in level of detail, okay? So let me show you Frank and Joanna's sample report. Now you'll notice the quarterly performance report will be sent out every quarter, but it will be based on every 6 months. The reason for that is, as I'm sure you know if you've completed it, which is most of you, the risk assessment measures risk on a 6-month basis. That's how we measure how much ups and downs in the markets that you can stomach. And we will match up, for the next report, you'll see that will match up your risk assessment number, your risk number, with the actual return inside your portfolio over the last 6-month period. So that's why we'll always use 6 months, look back period of 6 months. Now, the most common question I get from any client is, how are we doing, right? How much money did I give you, and what's it worth now? And so this is Frank and Joanna's 30,000 foot view of how they're doing. You see two things going on here. The first one is the net amount invested, which is how much money they've put in or taken out. And the market value is how much that money that they put in or taken out is worth today. So Frank and Joanna are retired, and so they're drawing down from the retirement accounts, and that's why their net amount invested is steadily decreasing. Those are the monthly paychecks that we're sending them. The blue mountain range piece of the graph is the actual market value of their portfolios, of their household. And so you can see it's been a good year in the market, certainly. As you can see, Frank and Joanna are actually taking money out of their accounts, out of their portfolios, and yet it's still growing because things have been so well. We should all be that lucky, shouldn't we? Now we did get into a little bit more level of detail with performance history table. What this details is the details within each account. So Frank and Joanna, in this example, as a sample, have 3 different accounts, a cash bucket, long-term bucket, and a short-term bucket. The period is the last 6 months that I just mentioned. The 1-year period is a performance for the last 12 months. And the since inception is since inception, which in their case is going to be August 29th, 2016. Now I want to stop here, a little footnote. All of you will see inception dates of as far back as August 29, 2016. Now, I know that I've been working with many of you much longer than that, but the inception date starts when I started working with this performance report company. So the date only goes back to when I signed on the dotted line to hire them. I have separate spreadsheets that I've kept that are for a lot of you. So if you want to dig into further detail or are curious about the real lifetime of our relationship, then we can certainly discuss that on a one-on-one basis. But for the majority of you, we'll go back and moving forward, 8/29 or thereabouts will be our inception date forever and ever. All right, so it just breaks down the account returns on each level. Obviously, the cash bucket is going to have a pretty low return. The short-term bucket is going to have a pretty small return as well. And then the long-term bucket, which is geared for growth and invested in the markets, is going to have a larger return. So there it is. Getting into further detail, we have the activity summary. So let's just break this down. I know there's a lot going on here, but it's actually very simple. It's basically just money you put in or took out, plus any market gains you've received. So the beginning market value is pretty straightforward. That's for the period, which would have been 6 months ago, and 1 year, which would have been 12 months ago. Contributions, distributions, and transfers in and out. That has nothing to do with investment performance. That is purely what Joanna and Frank have either put in to their accounts or taken out of their accounts, right? That's obviously going to impact the net value, the ending value here on the bottom. Now, the next section is a very important section, one that I want to highlight, the advisory fees paid section. So when I started the Financial Zen Group, I am making it my mission to correct a lot of the problems that I see within my industry. One of those problems that I believe is they hide the fees from you. You can find them out if you know where to look, but they certainly don't put it front and center on their performance statements. They make you dig for it on like page 9 of their 1099. And I'm not just talking about my former employer. I've seen a lot of people and a lot of different financial institutions, and they all do the same thing. They figure, if you don't know what you're paying and we make it tough enough for you to figure it out, you're not going to ask any questions. Well, I think that's kind of silly and not really client focused, if you ask me. So you will see I always make my advisory fees and what you're paying me front and center. Here are the fees that Frank and Joanna would have paid me over the course of the last 6 months and the last year. And that is the only way I'm paid. I'm not compensated any other way by Charles Schwab. I'm not compensated by any fund companies. I'm not compensated by people that are referred to you for insurance or estate planning or taxes, anything else. The only way that I'm ever paid is by the fees that you pay me, which are outlined here. All right. Now, for this first go around, most likely everybody's going to have miscellaneous charges listed. This is going to be a one-time fee. Those are transaction fees that were charged when we upgraded the portfolio from the Wells Fargo portfolio into the Charles Schwab portfolio. One of the reasons that we're invested the way we are at Schwab is that it is cheap as all get out, all right? There will be no transaction fees at all moving forward the way that we're invested, as well as the ongoing annual expense ratios have been reduced by tenfold. Okay, so they were about 1%, give or take, at Wells Fargo. Now they're 0.1% with how we're invested at Charles Schwab. So you'll see miscellaneous charges this time around, but no time moving forward. All right. Now we get into the stuff that, is what you're really looking for, right? How much money have we actually made, right? So this is the next two lines. So the first line we have here is dividends, interest, and capital gains. It's pretty straightforward what that number entails. And then market value, which is just anything on any unrealized gains, right? Any gains in the markets that we've experienced, but we haven't collected and taken for our own yet. So in Frank and Joanna's case, they've made what looks like about $68,000 or so over the last 12 months. All right, and then we got the performance numbers again over here. Okay, moving right along. Next up, we have the allocation overview. Now, don't forget, I've told you this, I'm sure if I've told it to you once, I've told it to you a million times. The most important part of your investment strategy is the ingredients you have in there and how much of each ingredient you have in there, right? The asset, that's called the asset allocation, and it accounts for 90+% of your portfolio return. So in Frank and Joanna's case, these are the ingredients. The asset classes are the terms for ingredients. And then we have the allocation, which is how much of each ingredient that we have in there. In Frank and Joanna's case, they are already retired, so we got half in safe money, right, in bonds and cash, and then the other half in growth-oriented money to keep up with inflation. So you'll have one that's customized for you. All right, and then the last household level section is fixed income. Now, if you are retired or near retirement, you'll have something here. If you're still in the accumulation phase of life where you're still just looking to grow your money, you won't see this section. Since it doesn't pertain to everyone, I'm going to skip it for now and circle back to it towards the end. All right. Okay, next up, like I said, I want to make the advisory fees front and center. I want you to be aware of what you're paying me, and I want you to feel like you're getting value for that money. Based on feedback I get from all my clients that I've asked, at least, it sounds like everybody feels like they're getting a pretty good deal from me. Frank and Joanna, they have 3 different accounts, so this is broken down by billing period. I bill it at the end of each month in arrears based on your average daily balance, which is basically just a fancy way of saying you're billed a very small percentage each day. That's the fairest way to make it happen. So here we have Frank and Joanna's monthly fees. That would have been for April, right, with the total. And then we got May, June, July, August, September, etc. And then the total for the 3-month period down here. All right, so very straightforward, very easy to find. Second section of your performance statement. All right, now if you're a headline kind of person, that's probably as far as you'll want to go. If you like to get into the details, the next sections are for you. The next sections detail the actual account performance broken out by account. So some of the things that we just reviewed for the households are included here, like, for instance, the overall what you've put in versus what the market value is. Now, this account is Frank and Joanna's cash account, so there's not much going on here. So I'm going to skip to something that's a little bit more interesting, like their long-term bucket, right? So this is all their long-term bucket. This is invested in the market. Here's the invested value comparison, just like the household, so that should be pretty straightforward. This is the first new section here. Now, Frank is a little bit more conservative, so we have his long-term money invested in a conservative model portfolio, okay? This is the benchmark, how we want everything invested. This is how it actually is invested. These will match up pretty closely most of the time. Here's that pie chart broken out into percentages basis. So the way this works is the actual numbers will go up and down based on what the underlying ingredients have done, right? And when they get too far out of whack, what we do is we basically hit the reset button. That's called rebalancing, right? In investment terms. And we hit the reset button and we bring it back to the model portfolio, right? Back to these exact percentages, and then we let it run for a while. So that's how the rebalancing strategy works. It's proven time and time again that the most effective way to do it is like that. It's called a tolerance band basis rather than a time-weighted basis, rather than on a annual or quarterly basis. So that's how that will work. Next up, next section is new as well. This is performance by asset class. So we got all those ingredients in this portfolio, right? This breaks out the performance of each of those ingredients, okay? Now, the reason this section is important is because it shows you and reinforces the reason why we stay diversified, right? The reason that we invest this way. Nobody anywhere in the world, not me, none of the talking heads on CNBC, nobody, not your neighbor who says they, predict every market downturn since the turn of the century. None of them can actually predict what's going to happen in the future, right? And that's why we own a lot. We own a little bit of a lot of different things, right? So nobody knew that emerging markets was going to kill it this year. It's kind of stunk for the last few years. So it's having its day right now. Nobody knew that foreign small and mid was going to not do a whole lot this year. So that's why we own everything. So this is details for your actual for the ingredients within your portfolio. And then these are just the numbers broken out with your total return for that account here at the bottom. Next up, we got the activity summary, which is straightforward. I won't review this again because we've already done that first, but exact same deal as the household activity summary except for your account. And then the last new thing here is the benchmark comparison. Now, what you're going to see here is a comparison of the track that we're on and how we're actually moving along that track. So the blue kind of box section is the actual benchmark. The green part is the return within your portfolio. Now, most of the time, it's going to look mostly like how this period return does for Frank and Joanna. And the reason is that we're essentially invested like we are, like the benchmark is, right? But you're not paying fees from the benchmark. Now, you're paying, when you take out the fees, you're going to be just a little bit below the benchmark, which is why you'll always see just a little bit of space between the green and the blue box there. Now, if you're looking at your benchmark comparison, you're seeing something out of whack like Frank and Joanna are here, whether you're above it or below it, that's probably just a matter of timing. A lot of my clients brought their money into Charles Schwab where it sat, and then we took a while to get our risk assessment done, let's say 6 months. We got that risk assessment done. We put you in a conservative portfolio benchmark of 40, and now it's 6 months past that. So the benchmark will look back and assume that you were in the whole thing since January till now, when really you were only in that benchmark in that model portfolio from May until now. So if that's the case, and it's just a matter of timing, your year and inception numbers and maybe even your period numbers could be a little bit out of whack. They'll normalize in future reports. And if you have any questions, certainly feel free to ask me and I can walk you through yours personally one-on-one. Then the very last part of the account-based section is really just so you can see it's the nitty-gritty detail. It's the actual ETFs that we're invested in and how much we have in each ETF. Like I said, we're using Schwab accounts because ETFs are commodities, so it makes sense to use the cheapest, and Schwab's are the cheapest on an annual expense ratio basis. And because they're Schwab and we're with Schwab, they're not going to charge us any transaction fees when we rebalance or shift things around. All right? Okay. Now, if you're a purely growth focused person, if you're in that accumulation stage and you're not anywhere near retirement and you don't own any fixed income, then that pretty much does it for you. Feel free to sign off. And if you'd like further information, schedule 30 minutes with me. I'll walk you through your individual performance report. If you are at or near retirement, then stay tuned for just a couple more minutes here and I'll walk you through your bond portfolios, your safe money. So here we have Frank and Joanna safe money. The reason I put it at the top is because I think it's important that you understand where your living expenses, how far out your living expenses are funded. So this is the bond portfolio. The two main columns that you want to concern yourself with here are the maturity year, right, these years, and then the units. Now the units are actually dollar amounts. So in 2017, with 2 months to go, Frank and Joanna will still have another $20,000 in bonds that will mature. That will fund their living expenses for next year. Next year, they have $40,000 maturing. That will fund their expenses for 2019. So you can see we're always 1 year ahead of each other, so we're always funding our living expense, our cash bucket, a year in advance. So those are the only two columns you really need to concern yourself with. The rest are things that I can't delete. It's highly customizable, but not 100% customizable. And these deal with market values and unrealized gains and losses, which if we're holding them to maturity, which we are, don't concern us. And then the very last thing that I want to show you on the fixed income is how to measure their performance. What are you actually getting out of that deal, out of holding those bonds? And that is in your account subsection for whichever account holds those bonds. And that is right here. So fixed income summary information. The two main pieces here are the annual income right here, as well as the yield to maturity right here. So the yield to maturity is the actual return that you're getting. If we hold this bond to maturity, which is the plan, and we will, then we know we're going to get 3.65% per year. That's why we invest in bonds. They're highly predictable. We know exactly what's coming, right? And that 3.65% return for Frank and Joanna translates into $31,000, a little over $31,000 in annual income from their bond portfolio. All right, so I think that's enough. I'm trying to keep it, trying to give you just enough. If you want more, I got a lot more. This is just the tip of the iceberg, but I think it's as much as most people can handle. So if you want more, feel free to schedule 30 minutes with me, and I can walk you through anything else you might have questions about. I'm also very interested in your feedback. I want this to be as meaningful and as valuable to you as possible. And the more feedback you give me, the more I can tailor it to your specific needs and improve upon it. So thanks again for tuning in. I hope you found this informative. I hope you enjoy your first performance report. And I will see you in 4 weeks. Thanks so much.